Okay, you got it going?
You're good.
Good. So we're going to get this next speaker up here, and we got, as you can see up here, Tom Wilson is here, and we're going to have Zach give us just a little bit of rundown, so you probably want to get that video on Zach there, and we will continue to move on when people come in. So, Zach, you got it.
Great. So up next, we got Tom K. Wilson, who's a 4-decade real estate investor who transitioned from a 30-year engineering career managing some of Silicon Valley's pioneering high-tech companies to a full-time real estate investor in 2000. Since then, he's bought and sold over 2,000 units and over $100 million worth of real estate, including 7 apartment buildings, 3 condo conversion projects, 3 syndications, and has flipped over 350 homes. One of his companies, Wilson Investment Properties, provides quality, turnkey, high cash flow rental homes in both Dallas and Fort Worth to other investors. Tom and his wife of 47 years live in Silicon Valley, have a daughter and family here in Santa Barbara, and are very active in the community and church. Tom is a frequent speaker at REIs, has a weekly radio show on real estate investing, and often mentors new investors. He will now share with you some of the investing experiences and tell you how to find the best cash flow properties in the U.S. Give him a warm welcome.
I think I called a short straw after lunch, huh? We'll see if we can bring them in.
Okay.
Thanks for coming. Thanks for having me, Linda. Linda here somewhere.
There he is. Okay.
My pleasure.
So we're going to talk today about give you some of my experiences and what I've learned from real estate investing. We're going to talk about where the real estate market has been and where it's headed, give you a little bit overview of my perspectives on what's happening. I'm going to talk to you about the methodology that I feel is the way that you should go about selecting where you invest and what you invest in, and how do you select a region and a product. I'm going to talk about my favorite area that I've chosen to make most of my investments in Dallas-Fort Worth area. I live in Silicon Valley. My corporation that provides rental properties to other investors has about 6 people in Silicon Valley. We have about a dozen people on the ground in Dallas-Fort Worth that do the day-to-day operations. So I came to Silicon Valley in '69 from the East Coast. At first landlord I talked to lived next door, and he owned half the street. I'd never heard of that. Never heard of that idea before, so I planted the seeds. And when it came time to think about what to invest in, that's what I decided to do. So we bought properties back there in the 70s, and believe it or not, in 1970 you could buy a house in Silicon Valley for $30,000 that would rent for $300. It's a 1% ratio of back there in those times. No more. We'll see some more numbers like that and why we invest out of state. So for those of you that are here, how many have rental properties now? How many have rental properties out of state? Okay, not many. All right, I'll show you why I made the big move. So I did 30 years in high tech. A couple startups that didn't hit a home run, a number of larger companies, and in 2000 I decided that I was a little burned out in high tech, and my real estate was contributing more toward my retirement than my 401k and my stock options were, so I went full-time toward real estate. And little did I realize how much I'd wind up being immersed in that business, but it's done very well for me. The first thing I did, being an engineer by education, was, and a very analytical person, was to study the country for a year and figure out which metro I was going to invest in. And what I wanted was the highest cash flow I could attain, and one that would protect that with future. And Dallas-Fort Worth came out on top. So in about 2005, 2006, I had a lot of peer investors who were seeing what I was doing with investing there, and they said, well, I'd like to do that too, but I don't have the time or the knowledge. So we opened up a company, Wilson Investment Properties, and we provide about 350 turnkey, meaning carefully selected, rehab, rented, and sold them to investors, mostly here in California. So even though I have a lot of experience and did in 2008, I must confess that 2008 was tough on me too. In fact, that's what I looked like before the crash. haven't fully recovered. All right, I got a lot of slides, a lot of information for you, so fasten your seatbelt. We're going to go through. Not going to go through all of these, but does everyone understand the difference in gross rent multiplier and buying? Sure.
Then everyone can see your slides.
Does everybody know what the difference is between gross rent multiplier and
No.
if you can look on that. And rent ratio. So rent ratio is the monthly rent divided by the value of the property. It's a monthly inverse of a gross rent multiplier, which is known in the commercial world. In the commercial circles, gross rent multiplier is the annual rent that's divided into the price of the property. So it gets you the same place, but if you're talking to commercial people, they won't know what you're talking about on rent ratio and vice versa, but they're the same thing presented in different ways. That better? That help? Okay. So there's lots of different things you can invest in that you can be successful in, you know, and people used to ask me when I was in the high-tech world what I was in, and I learned very quickly you can't just answer high-tech, right? There's all kinds of things. Well, just like real estate, you can't just say you're in real estate. What kinds of real estate? Are you in buy and hold? Are you doing flips? Are you doing multifam, commercial, houses, land banking, development paper, all kinds of things. All of them are certainly viable for making money. And just looking at multifam versus 1 to 4s, what are the pros and cons of which of those to look at? Well, multifam, I've owned 7 of them, I have 2 of them now. They certainly have value, they have potential of making more money, but they're a lot more moving parts and a lot riskier. So you got to be very careful when you go down that route. And I don't advise it to anyone that hasn't already had a fair amount of experience in 1 to 4 residential products. First of all, you can't even get a loan. Right now, money's so tight that if you don't have experience and ownership already in a multifamily commercial, you can't get a Fannie loan. You might get a regional bank loan, but then you've got to be in that region, and those terms aren't going to be so good. One way you can do it is through a syndication. And we've done that in the past. We're going to start syndicating again, so if there's anybody who's interested in putting money toward a multifam or single tenant triple net deal or something like that, let me know. We're going to start putting those together because we'll have partners that have experience, can qualify for the loans and so forth. So that's the safest way to go into something like that. But with houses, what do I like about houses? They are, they're more liquid, they're simpler, their values go up with owner-occupant demand, not just from how much the rents and income go up like it is in commercial. So, and they're a lot easier to manage, and you can distribute them over a large area, so you kind of build a mutual fund of that kind of real estate that does not have all your eggs in one address. No matter what kind of real estate historically you invest in, whether it's apartments, office, industrial, or retail, they have traditionally always outperformed the securities marketplace. So it's still, real estate's still the best, I believe, for leverage, sheltered, and controlled vehicle for cash flow and accumulation of wealth. So here's some tips that I've learned through my experiences of investing in real estate over these 4 decades. Be careful what persons of influence tell you, you know, especially from a political position, because they have an axe to grind, right? They've got certain positions they're trying to promote. Believe it or not, in 2005, before the crash, Bernanke said we've never had a decline of housing prices on a nationwide basis. What I think is more likely is that house prices will slow, maybe stabilize. I don't think it's going to drive the economy too far from its full employment path, though. Calvin Coolidge in 6 months before the Great Depression, said that in his State of the Union message that the affairs of the nation were as good as they'd ever been. So you got to be careful. I believe in buying in top metros. Believe in buying for cash flow. Look for the best neighborhoods, submarkets. Even though I've had a lot of experience in a couple of markets, Silicon Valley area and in Dallas-Fort Worth, I think I would take some skill sets with me that would help me in finding the best products in another city, but I wouldn't dream of going somewhere else without finding experts there that knew the neighborhoods and products and demographics of each of those little submarkets. You know, what's most available data-wise when you go to Google for it is kind of metro information, right? But that's really not enough. You really need to dive into each little submarket, and within those submarkets, you know, different price products do things quite differently. So you really need an expert in that area. That's and look for experts who are not just say in real estate. All of our professionals that are part of our team to support our clients work either predominantly or exclusively with investors, whether it be a lender, whether it be an agent or broker. You know, it's only about 2% of all the real estate agents in the country really focus on or know a lot about investment properties. So be very careful whom you choose. Got to take the emotion out of it. You're not buying for yourself. You got to buy a product that makes sense from a business standpoint and the numbers work. And for any of you that are still a little nervous about going out of state, if you've only invested here or live here, I too was nervous back in 98, 99 when I'd never invested out of state, and I found, oh my gosh, the cash flow potential is a lot better somewhere else. And but I had one mentor that I was talking to about it, and I said, all right, I'm kind of ready to pull the trigger, but I'm a little bit nervous about this going out of state. And he said, Tom, have you ever bought any stock? I said, well, yes. He said, when you buy the stock, do you buy it because it's a company that's in your backyard and you get to go interview management? No, he took the wind out of my sail. Of course, you go get a product that's the best return on investment. If it's managed well, it doesn't make any difference where it is. You want to focus on being an investor, not a landlord. I made that mistake early on. We kind of stopped buying in Silicon Valley after we got 6 houses because we got tired of dealing with tenants. But it didn't occur to me that you can offload that. You can contract that out so you can focus on investing. So I think there's some value in being a landlord for a while. You get to learn what the demands are. You get to learn how to manage your property manager and what questions to ask when you screen to find one. But after that, focus on being an investor. Let someone else do the landlording. That's not a very pleasant business, and only a percentage of all of them do a really good job. And that's where it becomes very important to find a good team. You want a team that's already done that vetting and done that screening for you, so that you know that when you're getting a product, if you get it from a turnkey provider like Wilson Investment Properties, you've got a team that's already screened and filtered for the best quality professionals they can find. When you're investing in real estate, or go into any other venture for that matter, I believe that most people underestimate their generalist skills. Maybe if all you've done is written code in a corner for 5 years, you don't have a generalist skill. But if you've been in business for a while, any kind of businesses, you've got more generalist skills than you realize. You've got communication skills, management skills, supervisory skills, advertising, marketing things that you've learned. Don't forget to transfer those over to whatever other business that you're doing. I think a lot of people make the mistake of thinking that their value is tied to the product or service that they're involved in an industry right now. And they forget that you can transfer most of those generalist skills in that product or service over to something entirely different, like real estate investing. So let that leverage your success. Don't get too much on your plate at one time. Occasionally I'll run across someone that says, oh, Tom, thank you for your advice. Since I saw you 2 years ago, I've bought 9 properties. And I said, well, great, where'd you buy them? Says, oh, I have one in Atlanta, and I have one in Dallas, and I have one in Phoenix, and I have one in Orlando, and that's a nightmare to manage. Don't get too many different things on your plate at once. Focus. As I said earlier, different regions have different cycles, different submarkets have different cycles. Make sure you have someone who's an expert in these submarkets and see what the economic trends are in those areas. Don't worry too much about what the appreciation is of the product. Don't just Google for top predicted appreciation growth city like the next Henderson, Nevada in the next decade. What's more important is how much return you get on your down payment. So if you're in an area where you can leverage reasonably high, 75, 80%, and it's only appreciating 5% a year, like Dallas-Fort Worth has done over the last 2 decades as an average, you're getting 4 to 5 leverage return on that down payment, right? You're getting 20, 25% return on that down payment. So if you have a product in California and you have to put down 80% in order for it to cash flow, and it appreciates 10% in a year, you're not getting as much return on your down payment as if you did in an area that has higher leverage. Asset protection. I think if you're doing a partnership, if you're doing a big project, syndication, a multifam, commercial product, then I think there's a place for entities. Entity being something that gives you liability protection like an LLC or an LP or an S Corp, that sort of thing. I'm not an attorney or a CPA, but I'll just tell you that myself and most of my peer investors who have a large amount of holdings don't hold any of our houses in LLCs or LPs. Why is that? Well, if you live in California, if you have one of those, you've got to give $800 a year to the state. You've got to have the accounting cost and hassle of dealing with it. You've got to set it up. And I won't say that has no value, but for me, it doesn't have the return on investment value. So when would that do you any good? In order for an entity to do any good in liability protection, you have to have a problem. You have to have a problem that can't be solved. They have to sue you. You have to lose the lawsuit, and it has to be something your liability insurance doesn't cover. So you got to get through all 5 of those gates before that entity has any chance of doing you any good. And in all states except Wyoming and Nevada, if it's just for yourself or yourself and your spouse, that corporate veil can be easily pierced by any prosecuting attorney that is worth their salt. So single member entity does not give you much value. It might give some psychological value to someone considering suing you. And I have to tell you that, knock on wood, hopefully there's some wood under here, that in the 2,000 units I've done in DFW in the last 15 years, I've never had a lawsuit related to a rental property. So they're less litigious there than they are here.
Is there a tax effect?
Yeah, of what?
Of having it in the LLC versus your own?
None that I know of. Remember, one of the many advantages of real estate is that the depreciation that you get to take, assuming you have a loan on property, the depreciation that you get to take is greater than the cash that comes in. So it gets to offset that income, just like you had to write a check, but you don't. So your income from your rental property isn't taxed for several years until maybe it gets higher than the depreciated amount, and then it's just for that delta. Yes?
Everyone and their brother has recommended LLC and S Corps.
I'm sorry, who has?
Everyone and their brother has recommended
Yes.
for LLCs and S Corps.
Yeah. Are the ones recommending it sell, are they selling LLCs?
No, just everyone, and I've done a lot of homework on it. But are you saying you're putting all these properties in your name?
That's right. Living
Okay.
trust.
Oh, living trust.
But it gives no liability protection.
Okay,
So I believe in avoiding probate,
so it's going into a trust.
but
fine.
it just avoids probate, but it doesn't have any liability protection.
Okay.
Yeah. What's the typical income from a rental house? $2,500 a year. $800 for an LLC to the state every year. 33% of your profit gone.
Yeah, it's a rip-off.
Oh, okay, well, let's put several properties in there, then that would cut it down for property. Okay, so you get sued on one property, they can't come get your house, but they can go get the assets from another property. So if you really gain anything at that stage. So I think it's expensive insurance, I feel, personally. Most of the people that recommend them are selling, doing them.
Do you just do an umbrella policy, for example?
Yeah. I carry liability insurance, I carry, for me, I carry $25 million umbrella policy, which is pretty cheap. If you're doing, buying properties on your own, and comparing it to getting it from a turnkey provider, and you haven't done it much before, just recognize that there are a lot of costs that most people don't think about. And very few wind up spending as the same or as less than what they were planning to do. So look at all these things that a lot of people miss that. Or, they'll, like people go to Vegas, right? They'll tell you about the wins, but they don't tell you about the ones that didn't turn out so good. So just be careful about that. Any of you know Bruce Norris? Know of him? Never seen him speak? He's a rock star here in California for education, and he's a very experienced investor. He's a good friend of mine, and he is considered to be a real estate timing expert. The Norris Group's a great website to go to. They have a radio show, a lot of good education information. I thought in early 2003, 2004 that we were building up a bubble, and I was getting nervous. And in 2005, Bruce said, "Tom, get out." So in 2005, 6, 7, I started selling off my California real estate, saving a lot of money. Bruce, a couple of things that he has concluded from his studies are that in order to predict timing in real estate markets, the one is affordability index triggers usually a downturn in the market. We've had 3 major bottoms of real estate markets here in California in the last several decades. 2 of them hit 17% affordability index. Everybody knows what that is. Affordability index is the percent of people at today's interest rate who can afford a medium price home. And when it got down to 17% the last 2 times, we crashed. And this very past one we've just been through in 2008 went down to 12% here in California, 12%. So as that's approaching that number, look out. It triggers. It historically is triggered when we're about to crash. Yes.
What is it now? What is it now in California?
Up in 30. Well, it depends on statewide it's upper 30s, I believe. But the last time I checked. But again, it varies tremendously by neighborhood. So you want to go see what it is in the particular neighborhood you're considering investing in. Because there are some now that are back down in the teens, and there's some others like Riverside that I think are still up in the 50s. So again, you want to focus on the neighborhood that you're considering. And a major indicator of when things are going up is inward migration. Don't be in too big a hurry, especially when you go through a time like we've just been through, and there's we've had some big losses, and I don't know anybody that wasn't hurt by this downturn. One of my neighbors is a bankruptcy attorney, and I said shortly after say in 2009, I said, "Sam, I guess you're about the only one around here who's benefiting from this crash." He says, "No, I'm hurting." I said, "Why is that?" He said, "Aren't bankruptcies up?" He says, "Yes, but all the corporate attorneys that got laid off are competing with me." So don't be too quick to be judgmental. Everybody got hurt in this. So in an effort to quickly recover, don't be in too big a hurry because you'll take on more risk. Better getting solid things that will get you back in the long term. When you make a mistake, don't run from it. Go stop, analyze it. What were the mistakes? What could I do different next time? Sometimes, painfully, those are the most valuable things that we take with us moving forward. Great principles aren't always complicated. Don't miss the obvious and the simple. Conrad Hilton, the first big developer of the first international hotel chain, his son was asked one time, to what single thing did his dad learn that was the most valuable in all of his hotel experience? They said to leave the shower curtain inside the tub. So what happened? Easy money, let's just take a quick review of what happened so we can get an idea of where things are probably headed. In the last, as we know, we've had very easy money in the last decade. Why is that? Politicians like to be popular, and so if they get everybody in a house that brings votes, was it the banks that were at fault? I don't think so. I think it was their politicians setting policy that would make them popular. So if there's no risk for an investor like a bank, most anybody's going to take advantage of that. The risk is taken away, then shoot, let's go do that. And then of course it trickles on down. The loan officers and the appraisers and everybody else, got involved. And so with this government intervention that made these rates so low, it was so significant that it even masked the natural business cycles that should have had us correcting back in the early 2000s, the post-com bust. Usually when employment drops, that's when the real estate cycles normally drop. But it did not, because we had such low interest rate, it even masked that. But of course, what we should look at is people all worried and excited that interest rates are up. That's how much they're up, right? Not much in the general scheme of things. When I started expanding significantly, interest rates were here, and I was just delighted to buy products, and they all did just fine, thank you. So interest rates are outstanding. So did we really have a housing bubble? No, we really had a credit bubble. Right? What happened was, as they continued subsidizing loans and making them easier and easier, the payments always stayed the same. It's just that payment then could qualify for a higher loan, which would qualify for a higher house. So really, it was just the houses going up in what people could pay. The payments stayed the same. So no wonder we were building up a bubble. Here's Los Angeles, San Diego, San Francisco. Median house prices, just reminding us of how natural business cycles, when the government intervention is taken out of the way, they tend to revert back to the mean. And here's the mean price over a long period of time, and look how it keeps coming back. Here it did, here it did. So these are things that help us predict where things are going if we understand what happened in the past. Right? If we had totally free markets, it would be a lot easier to predict. But now, in addition to understanding free markets, we have to understand what's going on with government intervention and how these different rules and interventions are affecting and altering the normal business cycles. It kind of feels like where we live that maybe the problem is over, but you look at the graphs here, and you can see that there's still substantial delinquency going on out there. So we're not done yet, and it varies a lot by region. So you can see the darker ones there are having a higher amount of foreclosures, and the lighter ones have less. Texas has always been, in spite of its low-priced houses and a lot of subprime loans, it has always had a significantly below average. In fact, I think it's the lowest of the major economy states in the number of foreclosures. We're seeing here that with Gen X and Gen Y that we have, it's more popular now to rent. So we have a lot less demand now for people who have sold homes to repurchase. It was all the way down here to 33% in 2010. Now it's up a bit. But this says only 49% today of people who either sell or lose their home have any intention or ability to repurchase a home. So that's good news to investors, right? That says that half of everything that's being sold needs investors to take them down. So that's good. At least I see it as that. So I've known Robert Kiyosaki for a long time, and spent a number of days with him a couple years ago. And what I like about him is that he sticks to the fundamentals. He's not a gimmick guy. And probably his most dominant fundamental that he keeps teaching over and over is to buy assets that produce income now. Gold I think has value in being a hedge against inflation. His advisor, whom I had dinner with not long ago, Andy Tanner, says, yeah, I get that, but the one problem with gold is it doesn't produce any cash flow. And so so to me, that's a really high priority. And single-family homes. So what things can you get that protect you against inflation? Probably any tangible hard asset, oil and gas, agriculture, real estate, things that are hard, tangible assets. I think inflation is inevitable. Don't know when or how much, but I want to have as many things as I can that are going to hedge me against that. So how do you select an area to invest? All right, so real estate seems to make a lot of sense to invest in, but where in the world in this huge country or internationally do you go? So I'm going to walk you through kind of my methodology of how I get there. So the first thing that I look at is where are the highest rent ratios. And then I look at, all right, in those areas, which of those areas have the highest probability of achieving it? It's great if it shows that a $100,000 house can bring in $1,000, but if it's empty half the time and they tear it up every time they leave, then it doesn't do you any good, right? And then what do you look for, and we'll look at that in a little bit more detail in a minute, but then what do you look for future? That's nice if I only have to live a year, but what if I want to make sure that 5 or 10 years from now I've got retirement income? What's going to contribute toward that keeping up with inflation, or hopefully more so? So then we have to look at, all right, well, population growth is what drives rents and values of products. And what drives that is jobs, so you got to look at the economy in the area. And then in order to find the best products in that area, you need an expert team. So let's go look at that in a little bit more detail. In 1998, when I first decided that I was going to start investing out of state for the first time, I was shocked to find that there was nothing out there published which told me what the most important factors were to look for. So being an engineer in the technical field, we do what's called a sensitivity analysis, where you take all the variables that contribute toward a bottom line and you move them a certain amount to see how sensitive the end result is to that variable that you're changing. So the variables in this case are rent ratio, interest rate, taxes, property management, occupancy, insurance, and repairs. So those are all things that affect the bottom line. Well, if you take an example and you change each of those variables by the same amount, it turns out that the rent ratio by far is the most dominant factor. So I hear people say, well, I wouldn't even consider Texas because the taxes are high. And yet they'd invest in San Jose where you get a 0.31% rent ratio. Well, that just doesn't make any sense. So that's how you determine what's most important. So you see interest rate is next most important, which is still at historical lows. So you got to find something where the rent ratio is high. So rent ratio divided by the rent divided by the value of the property is the rent ratio. Our rule of thumb in our investment businesses with a 20% down loan, you've got to have 1% or greater in order for it to be a good cash flowing property. Everybody know that rule of thumb? So how much does it vary across the country? Turns out a lot. It varies a tremendous amount. So if you can't see this in the back, we got like 0.37 in San Jose and 0.96 in Dallas and 0.94 in Houston and 0.82 in Atlanta and so forth. So that gives you an indication. Again, this is the broad sweep of the metro, right? Then you have to drill down to the submarkets. By the way, all of these slides are on my website, tomwilsonproperties.com. It's go there and look for the PowerPoint from this expo, and you can see all these slides. So what happens with rents versus property prices? Well, as you go up in time, or if you go to different locations, as the price of the property goes up, rents never go up in proportion to the value of the property. So, just for example, here's the first house I bought, $30,000, rented for $300, Silicon Valley. That house today is worth $800,000. I sold it in 2006. Got out at the right time. It dropped to $475. Thank you, Bruce. And rents for $2,500. So you can see how the rent ratio is degraded with time as the rents can't keep up with the prices. So let's look at an example here. So today, you could buy that house. Probably Santa Barbara is a good example, pretty much the same. You buy the house for $800,000 and rent for $2,500. You can take that house and instead buy $800,000 houses in Dallas. They will rent for at least $1,000 a piece, actually more. Or you get $8,000 versus $2,500. $8,000, $8,000. Don't need to be a accounting major to figure that out, right? So there you go. So you can, so you can't go back in time, but you can effectively do so by going to other regions where you get higher rent ratios. So great, that's the ideal. Get this rent, have no expenses other than the basic ones. So why can't you just pick anywhere? Well, it might not live up to what the potential could be, right? If you get in the wrong neighborhood or so forth. So these are some of the things that will not allow you to achieve that potential return on paper that looks like you might be able to. What if the occupancy isn't very high in that region because there aren't many jobs there? What if there's a collections problem? It's there are people who are living there. Being physically occupied is not good enough, right? You got to get the money in your pocket by the end of the year. So if you have trouble collecting, you don't actually realize that income. If they skip every 6 months and you got to go fix the place up and you've eaten away your perceived higher income, that doesn't help you. Your make-ready costs. What if it's an older property and there's deferred maintenance you have to deal with? That can eat. So these are all things that can erode your potential pro forma or income. So how do you guard against this? You get team members who are experts in it and pick the right property in the right neighborhood. So then what you want to be concerned about is, all right, in 5 or 10 years, will it still be okay, or will it be a Detroit going down? We don't want to be a Detroit going down. We want to be, we want to have higher rents and higher property values in the future. In theory, if it's producing the same income, and you bought it for that, for retirement income, yeah, there's maybe an argument that you're still okay. But if you have two choices, two places to invest in, let's go with the one that's going to have highest probability of higher rents and higher property values. So what are some of these things that affect that? The location demographics, the historical prices, where they've been, where they're projected to go, how's the employment in the area, how's the economy doing, how stable is the government, how business friendly is the government, things like that. So let me walk through as an example the area that I've chosen and use this same methodology, look at whatever areas you're considering and see and apply these same factors to it. So Dallas-Fort Worth has the advantage of being centrally located, being in the Sun Belt where transportation is very easy, rarely shut down. I'll walk you through this just a little bit. Dallas-Fort Worth is the 4th largest metro in the United States. They've got Dallas is the business capital of the South, just like San Francisco is for the West. Fort Worth is the traditional agricultural center, like San Jose used to be. This is actually the same area and the same population of the San Francisco Bay Area, 6.5 million. You've got these interstates that connect it this way, loops that go around each of them, and then you have Interstate 35 that comes up from Mexico, splits, recombines above it, and goes on up to Canada. So here's the airport right here in the middle. In 1973, when I went there in high tech to call on Texas Instruments, that's right over here, there were cows on both sides of the road when I was headed out there. No more cows, they're gone. So this is pretty well filled in. Arlington's the third largest city. This is the telecom corridor up here, 75. Anybody who's anybody in the telecom industry has to have a North American or world headquarters there, like Motorola and Nortel and all of them. So a lot there. Texas Instruments here in the corner. Over here is Lockheed, manages Joint Strike Fighter, largest contract ever led on planet Earth. Got a lot of medical over here. Got a lot of finance in Dallas. Very broad-based economy. Where do we buy? We do not go inside these loops. Demographics are lower. Numbers can look a little better, but again, what actually results is not as good. So we stay out of here. We don't go up into like Plano and some of these other areas that have beautiful areas and expensive homes and nice because they don't rent, they don't cash flow. You can't get the rent ratios there. So we tend to stick to the suburbs that are just outside the belt all the way around, and then carefully select the neighborhoods, or we have our property manager carefully select the neighborhoods. So prices, how do you tell what's going to happen in the future for prices? Well, there's no finite way you can predict, but you can certainly look at the historicals. So in yellow and dark blue and light blue, the real wiggly lines, that shows Nevada, California, Florida, shows the roller coaster ride it's on. Texas is the brown, boring one that goes through the middle, and it was so it averaged about 5% a year appreciation the last couple of decades, but it didn't crash like everything else. So it's more predictability, and I like that. Here it is by color. You see the what it's doing now. The dark blues are the ones that are appreciating the most right now. Other colors are not so much. And here's one I think is very important. Case-Shiller, everybody heard of Case-Shiller? They're one of the most quoted sources that take the FIHA data from the government and boil it down into 20 cities to predict what the same house prices are, not just tracking median, but the same house prices as you move forward. And this graph shows all the 20 major cities, how much they dropped. The peak went from the peak to the very bottom of the crash. And as you can see here, Dallas, Fort Worth dropped the least of any metro in the United States, 7.7%, the only single digit drop in the country. For Nevada, 58%, and everything else is in between. That, to me, is important. It shows me low risk price drops in the future. Percent of loans and foreclosures, showed a similar slide before. So Texas, again, is the lowest of all the major economy states, and the percent of loans, and that's current. So we're still got foreclosures going on. Jobs and economy. So you want to look at the region you're considering state-wise and region-wise and see how it's doing compared to everybody else. So this is during the crash. This is 2008 to 2011. And as you can see, the blue here is Texas, and red is U.S. average. So you can see that, yes, Texas came down, but it came down much later than the U.S., didn't drop as much, and recovered sooner and came up higher. And if you now extend that from 2011 up to date, you can see how Texas is running about double the job growth of the U.S. as an average. Those are very positive things. And if you look at it today, snapshot, Dallas, #1 in the country of all cities for the job growth that's going on. Other high ones are Houston, Miami. And you have to combine all these things together. You can't just look at one and say, well, I'm going to go there. You look at this and say, well, gee, that's pretty good, San Francisco, let's go there. But the rent ratio you can't attain, right? So you got to combine all these things. How broad is the metro's economy? I love Silicon Valley. I love Santa Barbara, but you don't have that broad a reach in economic economic sectors that they're invested in, so they tend to be a little bit more cyclical. I like that DFW has a very broad-based economy. In fact, it almost exactly mirrors that by sector and percentages of the U.S. So you can see it's a lot of different ones. Distribution is very big because of its location in that area. Finance, indeed, airline, very, very broad-based. Used to be, 50 years ago, a significant sector tied to oil and gas, but no more. Houston still is, but not so much Dallas. Here's Fortune 500 companies in DFW. It's the second highest region in the United States for revenue generated from Fortune 500 companies. It's the fourth busiest airport in the world. Everybody knows that Austin is the high-tech capital of Texas, right? Not so. More high-tech jobs in Dallas than all of Austin and Houston put together. It's the most dominant industry in Austin. It's actually only the third highest employer. And it's the most volatile, so Austin tends to cycle like Silicon Valley does, up and down based upon what it does. But the number of jobs is not as large as DFW. Fastest growing city in the U.S., 38 Fortune 1000 companies. State government financially very stable. In fact, it's the most stable and most surplus of any major economy state in the country. Cost of living is the lowest of any state. Independent of the grid, they could cut off from the rest of the U.S. and make it on their own. Population growth, one of the two highest growth areas in the country. Migration, remember we talked before about Bruce Norris saying how important inward migration is. A lot of migration into Texas and DFW. Predicted to go up another 50% in the next 20 years. Texas' second most populous state in the country. So, recap, it's the business capital of the South, highest rent per invested dollar for a major economic center. It's broad-based economy, physically strong government, rental occupancy is very high, running 99% for houses right now. So that's great. You like what you've heard, but how in the world do you go get a property and know where to buy? It's a big area, just like Santa Barbara, Central Coast, or Silicon Valley is. Wilson Investment Properties has a team of 6 there in Silicon Valley managing this business. So my core business is my own portfolio, and I manage that. So I have this additional business, Wilson Investment Properties, that provides rental properties to clients. And I use the same selection criteria for that for my clients as I do myself. I don't buy anything for a client that I want to keep for myself and buy for myself. And we have about a dozen on the ground in Dallas. 2 of our significant product differentiations. Characteristics of our company is that we have a much higher quality product than most of what's available. So I believe that helps you realize the true potential of the income, and we're very transparent. When I set up this company, I said, I don't want others to say to me like I say when I'm trying to, when I'm getting a product and looking at it. I don't want to have people frustrated and say, well, okay, it says it's approximately this rent, but what is it actual? Why don't they tell me what year it is? I got tired of those things. How are they establishing the value? So I didn't want any of that. So we go in the strongest rental markets. We have a full disclosure, newer products, quality mainstream products that aren't in inner cities, they aren't rural. All 3 and 4 bedroom houses, all brick, newer homes. They all tend to be in the $90,000 to $150,000 range. All rents when you buy it are 1% ratio or greater. So here's a typical product up here. right off the website. It shows you all the detail, everything in blue there you can click on so you can go drill down and get more data. So we have a pie chart that shows you what the actual today income and expenses are, not what they might be or hope to be. Give you a link to the public record so you can verify the data, link to the tax bill, link to the parcel map for the developer had, community overview so you can see demographics and the household income and everything that's going on in that area. School overview, we don't pick properties that are in bad school districts or high crime districts. We actually give you the CMA, the sales comps that we base the value on. Last 350 properties that we've bought and sold, I think we've missed appraisal 4 times. And most of that was during the crash time when the appraisers all thought they were going to jail and they're scared to death. And they were sending in appraisers from other cities that didn't know where they were doing. We have a tool on there where you can do your own what if on calculating internal rate of return and cash on cash return. Typical internal rate of return on these properties is about 20%. Everybody know internal rate of return? Anybody want to know? Don't know? Okay. So here's typical properties. 123,000, 1,290 a month, 2,400 square feet, built in 2005. Yep, that's a rental property. I don't see many of them here in California. Most of our agents don't mind touring our California clients. They enjoy watching them drop their jaw. They say they just know, they assume that many of them think they're Hollywood fronts, right? Can't be for real. And what's most frustrating is that most of the products that they buy for rent are nicer than what they're living in back here in California. But whatever. So there's another one, 135K house, right, built in 91, 136K house, rents for $1,450, 3,000 square feet, 2007. This is not out in Lincoln, Nebraska. This is in the fastest growing city in the United States. I still flabbergasted. So here's some takeaways for you. I believe true cash flow now is king, not maybe it'll sort of cash flow in a few years that everything goes right. Got to make sure it cash flows now. There's a time when we all invested for appreciation. You still can do that. You do carve out a piece of what you're investing, but be very careful. Flipping is very, I'm flipping a lot of houses. I don't make much money per, but we hardly ever lose money because we've got this system down and we've got this team in place that knows what they're doing. I flip about 6 houses to retail here in California. I'll tell you the profit jumps all over the map depending upon how things turned out. Be very careful if you want to jump in this flipping business. Yeah, it's a way to get some money that you can invest in long-term holds that will provide your passive retirement income downstream. But if you haven't done it, partner up with somebody that's done it. Very hard to find products. Don't bet on where that price you hope will be in 6 months when you're done. Make sure it will work now, and make sure you include all of the costs involved. Investor financing is available now. If you already have 10 properties and Fannie won't give you another loan, there are now several of these hedge funds that finally decided they're overpaying enough that now they're in the investor business. So, First P and B2R, part of Blackstone, and 5 of them out there now are providing loan money for people that have tapped out at 5. And get an expert team to get the best products. And listen to those that are respected in the area. I had the privilege of inviting Bruce Norris and Sean O'Toole, Howard Blum, to go with me back to Fannie Mae and HUD 3 years ago by their invitation to talk to their top officers and about how the investor should play a larger role in solving this problem. Probably shot ourselves in the foot because they turned on the hedge funds, but I think for society it was probably good because it did take down a lot of this inventory that was, foreclosure inventory, this delinquency inventory. But for Sean O'Toole, founder of Foreclosure Radar and Property Radar, great website, the Norris Group, great education, and he's just a great guy. And Dan, have you had him yet here? Bruce?
I would love to have him
I
here,
bet
so
he
if there's
can.
anything you can do to help us, that'd be
I'll
wonderful.
introduce you, see if we can get him up here, okay? So, so Paul Roper at senior fellow at Stanford University said, a crisis is a terrible thing to waste. So don't miss this once in a lifetime opportunity. Now's the time to plan for your retirement income. Don't sleep it away, waiting too long to make a decision. Go do something quickly. TomWilsonProperties.com is our website. You can sign up for a weekly economics newsletter. If you want to today, you can go back there to the log and we'll get you on there. No obligation. Your name doesn't go anywhere else. I have the fellow in the picture there with Bruce and Sean and me was Howard Blum. He's an economist who writes that newsletter every week to let you know what's going on in the world of economics as it applies to real estate. Nice little quick read so you don't have to try to wade all through Wall Street Journal and everything else. I have a report you can get, which is by the asking from the Silicon Valley to the heart of Texas. It walks through this methodology of how I figured out how to choose the best metro to invest in. I have a weekly radio show on real estate investing that's broadcast in San Francisco on KDOW, the Wall Street Business Network up there. And you can go on my website to get them in podcast form, or you can go on iTunes or YouTube. Go pick out the topics of interest to you and run them. And for anybody here at the expo today, we're offering a year free property management for any products that you're interested in buying. So thank you for your attention. It's been nice being here. We have time for a couple of questions. Dan, can we do a couple of questions? Sure. Questions?
What do you put for YouTube? Just RE360?
Put in TomWilsonProperties.com. Or just the easiest thing is go to my website, Tom Wilson Properties. And then it'll just right on my website, it'll be look at RE360 and you'll see the whole list. Just go to my website, you'll find it. That's the easiest way to get there.
I'm technologically challenged.
Well, that'll be the easiest way. Go to Tom Wilson Properties and you'll find the radio shows all there. Okay, that's been a lot of fun. Questions? What can I answer for you?
So do you you only choose the properties to purchase that you've already fixed up, or can you say the area that you'd like to invest in around Dallas, Fort Worth, and then you find the property in the area?
We have a whole bunch of wholesalers and brokers out there that are looking for the best products all the time in the areas that we tell them to look that we know are good. So they get the products, we take them down with cash, and then we rehab them and so forth. So you just go on the website, look at current inventory, and you see all the current products that are in the pipeline to become available. So usually within 30 days of closing on them, we have them rehab, tenant in place, and they're ready to buy.
Who sells them?
Or we have an agent in Dallas who covers it, and they can answer questions for you. Another question? Yes.
Does your company manage the properties?
Yes, we have an associate company down there that does the property management. So when you buy it, it's already been carefully selected, rehab, tenant in place, and property management in place. We point you to the lender. If you're getting a loan, we point you to the insurance people. So we pretty much hold your hand through the whole process. Usually looking at the time you say go, usually in 30 days, you've got a cash flowing property. About half of our clients go down and half do not. Welcome to, we love showing off our city and product. Yes?
So do you oversee the property management company?
I'm sorry?
Is this a separate property management company? Or is this
Separate property management company. We have no ownership relationship. Same property management company that manages a lot of my own properties. I got 200 doors of my own down there in DFW, and so I've already vetted them through my own experience. Yes.
What's the minimum you feel somebody can get involved in with the amount of money?
Usually about 35,000 per property. So you're putting down 20%, 25% plus closing costs of about 2% plus about 3%. prepaid tax insurance that the lender wants. So for 100K, you can get three cash flowing properties down there that look like this. Yes?
What kind of return typically can an investor get?
7 to 11% cash on cash return and about 20% internal rate of return. So internal rate of return, takes into account present future value of all the money that goes in and out of a investment, which is the only way to compare two investments. Say you're considering investing in a franchise versus rental property here versus rental property in Memphis, and really looking at the internal rate of return is the only fair way to compare two investments. So if you take into account the appreciation, the leverage appreciation, and cost of sales and all that, usually about 20% average annual over a several year period is pretty typical. Any others? Okay. Thank you very much.